Hey, it's Tom here and welcome back to the channel. Now in this video I am going to talk through the recent valuation update that I have done for Seritage growth properties. It's a video I've been promising on the channel for a few weeks, maybe even a couple of months actually at this point, and I'm finally sort of comfortable enough with the numbers that I've gotten at the end of this exercise to share them on the channel. And basically what I want to do is talk through the process that I went through to arrive at some of these liquidation value or intrinsic value numbers for Seritage growth properties, and then I obviously want to actually share the results and explain some of the things to keep in mind and some of the things that I'm actually still working on and potentially have questions around as well. So there will be timestamps along the bottom of this video. If you just want to jump straight forward to the actual numbers, feel free to do that, but I think it is important to just have a good understanding of some of the process and kind of assumptions that went into actually arriving at that liquidation value number. Now, very quick background on Seritage if you haven't come across it before. I'm sure many of you have if you're watching this video, but Seritage Growth Properties is a REIT, a real estate investment trust in the US. They own basically all of the real estate that had been spun out of Sears before Sears went bankrupt. We have Eddie Lampert, who has a big shareholding through his operating partnerships in Seritage Growth Properties, and they're basically taking these old Sears stores that used to be obviously rented out to Sears for a period of time at maybe $4 or $5 a square foot. They're taking those properties and either redeveloping them to get a new higher paying tenant, so paying anywhere from on the low end maybe $18 a square foot to on the high end as much as maybe $30 a square foot. So they're either getting in some of those new tenants through redevelopments. In some cases they're densifying certain sites as well, so they might even be demolishing some of those old Sears stores and putting up multi-family apartment blocks or a mix of maybe retail and office and multi-family housing and so on. So that's kind of one of the things that Seritage are doing. The other thing that they're doing is essentially selling off any properties that they don't see as attractive from a return on capital kind of perspective for redevelopment. So that's kind of the basic story with Seritage, and they're still very much in a transformation kind of phase and going through this process of selling properties or redeveloping them. And that means that they have negative cash flows right now, and they have done for the past few years. So in this video, I'm basically going to share two different sort of scenarios with valuation for Seritage. One is going to be if they theoretically just sold everything tomorrow, if that was possible, what would shareholders basically pocket if we took all that cash from selling every property, paid off the debt that they owe to Berkshire Hathaway, and then pocketed what was left over. What would that number be per share for the Class A shareholders? And the second, probably more realistic scenario is basically what does Seritage look like in, say, 2025, which is only 3 years away now, when they have a fully kind of redeveloped portfolio of cash flowing real estate. What does Seritage look like in that situation? What properties are they likely to have left? How much cash are they going to spend between now and getting to that point in time? Because they are burning cash at the moment. They do have negative cash flows. So what cash flows can we expect to see at that point, and what does that kind of turn into in terms of a share price and a value for that real estate? Again, keeping in mind the debt and some other things that Seritage has as well. Now, as always, when I'm talking about an individual company and particularly talking about valuation, do not take these numbers as gospel just because the numbers may look, interesting to you as an investor. Be sure to always do your own work, and hopefully this is a nice starting point and kind of shows you how I sort of personally work through this process. So in terms of basically the process that I went through, Seritage for a long time has been a little bit of a black box in terms of we know that they're going to sell some properties, we know that they're going to redevelop some properties, we know what properties they own. You can go on the Seritage website and look up all the addresses of about 170 different properties for Seritage, but we didn't necessarily know what they actually intended to do with each of those individual properties. We didn't know which ones were going to be retail, which ones were going to be office, which ones were going to be apartment buildings. But in, I think it was October or November 2021, fairly recently, they released their Q3 earnings, their Q3 results, and they also released a third quarter financial supplement document. And basically at the end of that document, and I'll put it up on the screen here, they listed every property and they categorized them into whether it's going to be retail or whether it's one of their joint venture properties, or whatever the use is kind of going to be. And then they also listed a whole bunch of properties in a category called Other, which my interpretation of Other, particularly after talking to Matt Peterson, who's done a lot of work on Seritage as well, my interpretation of Other is basically those are the surplus to requirements kind of properties that Seritage intends to sell to generate some cash to put towards their redevelopments or potentially towards paying down some of their debt. So in the first scenario that I have for Seritage, where I was basically looking at a liquidation value today, essentially what I did is I one by one went through every single property, grabbed the address for that property, and also looked at whether it was a retail or office building or whatever category it fit into. I then went over to another website. So there's a few different websites in the US where you can get comparable sales data for commercial real estate. So I picked up a 1-month subscription to a website called Crexy. I have no affiliation with Crexy or anything like that, but it was a really good resource, and I basically would take an address from that Q3 financial supplement document, plug it into Crexy, and that would give me a big long list of potential good reference points to figure out what that property is worth and what similar properties have sold for. And there's actually been a surprising amount of sales volume in and around most of these Seritage properties. In a lot of cases, I was picking up properties that were a similar size, that had basically the same use, whether it was retail or office, or in some cases just bare land. And they were all fairly recent kind of sales as well. It's not a perfect exercise, and on an individual property level, I'm probably not going to nail the value every single time, but spread over 170 properties, this directionally at least should be, a pretty good approach. So basically I went through every single property that SRG owns, and then figured out what I think those properties are likely to be worth. And along that kind of workflow, I was also sort of scaling some of the values up. So for example, if Seritage have a 5-acre property that's used for retail, and then I find a comp that is a 10-acre property also used for retail, and it happens to be just down the street, I would basically look at what that 10-acre property had sold for, cut the value in half to kind of adjust it for the different scale, different size of the property, and then I would use that scaled down number kind of in these valuations. Okay, so let's jump straight to it in terms of the first scenario I have, which is basically just if Seritage liquidated tomorrow, what would the real estate be worth after paying off the debts and so on. So I will also leave a link to the spreadsheet down in the description below if you want to download that and check it out. And if you've got any comments on kind of my approach to this or anything else you think I might need to consider, I'm definitely happy to hear that down in the comment section below as well. But yeah, in terms of the liquidation value for the real estate right now, I came up with about $4.16 billion US in terms of asset value for Seritage. And up on the screen here, you will see the breakdown of that with the different property category, whether it is multi-tenant retail or residential, or whether it's a joint venture or a Seritage are doing it directly. And with the joint ventures, I should note that I have just used Seritage's share of those joint ventures. Obviously, they're sharing the economics with some partners in those properties. So this is just the value of the Seritage kind of allocation of those joint ventures. So came up with about $4.1 billion in asset value. We know that Seritage has about $1.6 billion in debt to Berkshire Hathaway. They've actually recently paid a small amount of that debt off, although I haven't included that here because the cash balance that I'm using in this exercise comes from the latest 10Q as well, and I don't know exactly what the Seritage cash balance looks like after paying off that amount of debt. So I've taken the cash and the debt numbers just from the last 10Q to keep it simple there. And they also have some preferred stock as well. So when you look up Seritage growth properties, if you're looking to buy shares potentially, non-investment advice, don't just copy me, please. you'll see a couple of different share classes. So you'll see the Class A shares, and you'll also see some preferred stock, which I believe pays about a 7% dividend. So effectively the liquidation value if Seritage were to retire that preferred stock is another about 70 million. So we have 4.16 billion in assets minus about almost 1.7 billion in liabilities, which gives us a liquidation value of about $2.5 billion US dollars for the Class A shares. And the shares and operating partnership units that Eddie Lampert has currently sits a little under 56 million. So if we take the 2.5 billion, divide it by 56 million, we get about $44 per share. So that's a really interesting number to kind of see come out of this exercise for Seritage. Brad Kellner, stock compounder, went through basically this exact same process about 18 months ago. He landed on about $35 per share. We know that real estate prices have gone up a little since that time, and Seritage obviously has some debt and is kind of leveraged to that increase in real estate prices. So that's kind of where I landed. It's kind of hard to quantify here, but when I was going through and getting comps, I was trying to be conservative. Like if I had a property that, you know, was coming up at a comp of 15 million and there was an option there for 12 million, I was tending to go for the lower one. It's, again, hard to quantify the impact of that kind of flowing through here, but that's kind of where we've landed. And again, speaking to some of the other investors that have done similar work on Seritage, like Matt Peterson, for example, when I had him on a podcast a couple of months back, he mentioned that he thought Seritage had about 4 billion in asset value as well. So we're landing right in the same ballpark as Matt on this one, and you know, doing it completely independently myself, which is a pretty good sign, hopefully. Okay, so that is our sort of first scenario of liquidation value today. I don't think that Seritage are likely to actually go through and do that. So let's look at the second scenario, which I think is probably a more realistic one for SRG, and that's having a fully redeveloped portfolio. There's going to be a few more years of cash burn, and there's going to be quite a bit of capital expenditure to actually redevelop some of these, especially larger properties. But I think that's probably the process that SRG will continue to go through. And there's kind of two new pieces of the puzzle here when we go and look at this scenario. The first one is figuring out what some of these big premier development mixed use properties are likely to be worth in a few years. That's a tricky piece of the puzzle. And the second piece of the puzzle is kind of how much Seritage are likely to spend on capital expenditures over the next few years in order to get to that fully redeveloped portfolio. So in the first scenario that I showed before, for the big premium mixed use properties, I literally just valued them as bare land. When I went into Crexy and looked for comps, I literally just got bare land, no buildings at all. So I'm probably being pretty conservative with the values on those ones, hopefully. But in the second scenario, rather than using comps, I tried to calculate what the net operating income is likely to be for those properties, and then applied a cap rate, which is kind of the real estate equivalent of like effectively like a multiple of earnings. We can apply a percentage cap rate to that operating income and figure out what the value of each of those properties is likely to be. And for a lot of these premier developments, we can actually kind of scout around the web and find various different development companies who've published documents on you know, what the square footage is likely to be at each of these locations. So for example, the big one here, the big daddy for Seritage, is the Dallas property. I'll put up again some screenshots out of documents around the development for Dallas. It's expected to be about 2 million square feet, which is a massive development for SRG. And interestingly, in their third quarter results that came out just last year, they said during the third quarter of 2021, the company completed the first phase of its infrastructure work at its Park Heritage project in Dallas, Texas, and expects to complete the second and final phase by the second quarter of 2022. The project is entitled for residential, office, and retail, and the company is in active negotiations with various tenants. So for each of these properties, I was kind of going through and looking at, you know, what's the likely leasable area, how many square feet will Seritage have available, what's it going to be used for, and what are typical market rents likely to be in each of these different parts of the US as well. How much of that income, that rental income, are they likely to keep? I landed on about 55%, I think, being reasonable for a lot of commercial property. And again, if you download the spreadsheet, you'll see a massive list of different links and reference points that I've used to try and put this puzzle together. And I couldn't really decide between a 6% or a 7% cap rate, so I've gone ahead and used 6.5% as kind of a middle ground. And I suspect with a couple of these premier developments, I'm probably being far too conservative. For example, with their joint venture in San Diego, I was coming up with a property value of a little under $33 million, fully developed, using the assumptions that I just, laid out, with 55% of like an NOI margin, $20 per square foot in rent. And, when I was looking at land value only, comps were landing me closer to like $60 million. So potentially I'm way understating the rent per square foot that SRG can get off a couple of these premier developments. So if you've done any sort of work or scuttlebutt on these topics, definitely let me know down in the comments. Any help on that front would be useful. But hopefully that gives you a nice feel for what it looked like on the premier development valuation front. And another piece of the puzzle for this 2025 valuation is obviously the cash burn between now and 2025. Matt Peterson's done some good work on this, and Matt, if you're watching, I'm going to reach out to you and see if I can get some more info out of you on this one. But Matt basically said 3-year cash spend and project capital expenditures $800 million between now and 2025. That's some of the estimates that he put out last year. And that's something that I do want to kind of do more work on. So that's something that I'm going to roll with for now. Again, I may be being too conservative here and potentially doing a bit of double counting. I'm not sure whether that $800 million from Matt is just pure capex, or whether that is, all cash spend, like interest payments on debt and everything. But I've used that $800 million plus about another $305 million was my estimate of interest payments between now and 2025. So there's potential that I'm double counting there, and that $300 million in interest payments is actually already included in Matt's $800 million. Hopefully that makes sense. So again, I may be being a little conservative here. Again, I'd prefer to be more conservative than overly aggressive and kind of get myself in trouble with this one. So yeah, that's a lot of explanation. So let's just get to the actual results for 2025 values. So if I work through a lot of these property categories, I've left the valuations the same. So for multi-tenant retail, residential, joint venture, regular residential, I've kept all of those the same. I've assumed that they've sold all of their properties that are categorized as other, and I've just listed that as cash/other assets. So they can obviously use that to pay down debt and so on, and that lands me on about close to $1 billion actually. They're going to get a lot of value out of selling some of those properties. And that $900 million is sort of what's left after taking out the $800 million in, capex and so on as well. So I've just listed that as cash and other assets. Like I say, they could potentially use that to repay debt or distribute it to shareholders or do something else. But that's kind of just how I've listed it for now. So that now gets us to about $3.9 billion in assets. In our current asset value, we're at about 4.1. So we're now down to 3.9. We've had a big jump up in the premier development values for most of those properties at least, but we've obviously burnt some cash kind of between now and 2025 to get there. So that's where I'm at for asset value. In terms of liabilities, much the same, although I have, like I say, added in about another $300 million in interest payments between now and 2025. Like I say, I may be double counting there, but I'd prefer to be more conservative. And that gives us a 2025 value of just a little bit under $2 billion. And looking through the history of share dilution for Seritage, it's been basically nothing, like 0.1% a year, but I have added a very minor amount of share dilution between now and 2025 as well. And the final answer, the final number that you've probably all been waiting for, is that my estimate of 2025 value per share is right around $35. If I were to back out that potential double counting of interest payments, that would actually get me slightly north of $40 per share, but that's something that I'm going to have to kind of go and check on and make sure I'm accounting for that correctly. But I mean, that is kind of coincidentally exactly where actually Matt Peterson landed with his work on Seritage. He had a 2025 value of about $35 per share. Brad landed on about $35 per share when he did this exercise 18 months ago as a liquidation value. I obviously had a higher liquidation value today, and there's probably a few layers of conservatism kind of built in here. So $35 a share is about where I'm landing, but potentially it could be much greater all going well. So there you have it. That is my work on updating my valuations for Seritage growth properties. I do hope you enjoyed this video. Like I've said multiple times in this video, I just want to stress that this is not financial advice. Just because the future values may look attractive in my opinion compared to current market prices, please don't just go out and copy me. Do your own work on this one. And it's not the simplest business in the world to understand. There's still some potential unknowns, and it's going to be a pretty interesting one to follow over the next few years, that is for sure. But I do hope you enjoyed the video. If you did, please hit like and also subscribe if you're new here. Like I've also said a couple of times, if you think I've missed anything, or you've got commentary on the capex and interest payments and so on that I've included as well, definitely drop them down in the comments below. I would be very appreciative of any help you could offer there as well. But that's it from me for this one, and I'll see you in the next video. Cheers.